As a moderator today, we have Sunayna Tuteja, who is the Federal Reserve's first Chief Information Officer. She took that post in 2021, and she has been working with us across all business lines to bring innovation, technology, forward-thinking, and agile adjustments to the Federal Reserve Board. She's had a long history within innovation within the private sector, both in the Fintech and the crypto world. So she will be moderating a panel today, or a fireside chat today, with Vice Chair Michael Barr. Vice Chair Barr was appointed in 2022 to a 4-year term and has a longer term as a governor of the Federal Reserve Board. He was the Dean of Public Policy and Programs at the Michigan Law School. He was also the faculty director of the Center on Finance, Law, and Policy at the law school. He also co-founded the Detroit Neighborhood Entrepreneurs Project, which provides assistance and knowledge to entrepreneurs in Detroit, particularly small business. He's got a passion for communities and community action. He's got a passion for inclusion and being fair and equitable within the financial system. He's had several roles at the U.S. Treasury, was also a special advisor to the president in his past career, and began his law practice, or not his practice, but began his law career as a law clerk for Supreme Court Justice Daniel Soter. So without further ado, let's welcome Vice Chair Barr and Sunayna Tuteja. Thanks, sir.
Leave that one.
Sorry, that's not mine.
So I actually have some formal remarks to make before we get started with our chat back and forth. So I'll give those from up here, and then I'll join Sunayna on the stage. Thank you, Bill, for that kind introduction. Bill and I have a chance to work together a lot. Bill's very involved, of course, in supervising banks in the region, in the Reserve Bank district, but also very involved in national work across the system. So I'm grateful for his leadership. And Sunayna and I go back a long way in this space and have sat on panels together before either of us were in this current role. So I'm delighted to be able to join her on stage. Thank you very much for the opportunity to speak today in the midst of a wave of innovation in the payment system. There are a range of important players in the payment system, and the Federal Reserve has important roles both as a supervisor as well as a payments operator. Regardless of who is providing the service, our payment system needs to meet fundamental principles. Among those core principles is ensuring that the payments infrastructure supports broad access and promotes financial inclusion. Payments are essential for everyday life, and too often low and moderate income households and small businesses don't have access to the payment services they need at a reasonable cost. Moreover, as the payment system evolves, it needs to provide strong consumer protections. The payment system needs to welcome competition, provide consumers with choices, and support innovation. The payment system should empower consumers to have better control over their financial lives, including their identity and financial data. And more broadly, our payment system should promote efficiency, convenience, speed, low cost, resiliency, privacy, and security. Finally, our payment system must and does rely on trust, and this trust must be maintained as the system is updated. This includes trust that the payment system is not used for illicit purposes, that lawful payments will always be honored, and that neither the government nor private actors will act improperly based on the use of the payments infrastructure. Not that long ago, the Federal Reserve was facilitating payments by moving bundles of checks around the country on trucks and trains. And we still have important work to do to ensure that those who rely on checks can get their funds in a timely way, and that the system is not exposed to fraud. But more recently, the focus has been on improving our electronic payments infrastructure. The Fed has long operated the FedWire fund service, used by banks to conduct large-value same-day transactions among themselves. In addition, the Automated Clearinghouse, or ACH service, supports batch payments of more modest value. While the FedWire fund service and ACH transactions have served the economy well for decades, the economy has changed dramatically over that time period. There is a demand for faster payments, and the Fed has recognized that today's households and businesses would benefit from ready availability of funds 24/7. So in July, the Fed launched the FedNow service, a new service to make instant payments secure and convenient. FedNow enables instant payments to be processed on any day of the year for a broad range of transactions. The FedNow service is core payments infrastructure, available to all depository institutions, including large banks, regional banks, community banks, and credit unions. It is those institutions that will determine whether real-time payments are available for everyone. We have provided the rails. Innovation by private depository institutions will determine whether these services reach a broad range of households and businesses. While current volumes on FedNow are small, I expect that participation will grow over time and be a significant addition to and advance on the existing payments infrastructure. I view the FedNow service as complementary to the private sector instant payment services offered today. And as banks build on these rails, customers can get better service. Individuals could have instant access to their paychecks and be able to spend them on the same day, rather than waiting several days for checks to process. Or consumers could pay bills at the last minute on the due date, potentially avoiding late fees. And small businesses would benefit from timely payment as well. The benefits could be far-reaching and will be especially significant for low and moderate-income households. Banks and their service providers are already thinking creatively about how they can leverage these new payments rails to meet customer needs for immediate funds availability. Efforts by banks to meet the demands of their customers will support more robust offerings, and I look forward to engaging with banks about how they could be advancing financial inclusion objectives with faster payment services. Separately, we are engaged in efforts to understand the next generation of payments technology and how it can be used to support a secure and efficient payment system. As the pace of innovation increases, the payments landscape continues to evolve with the emergence of new programmable payments platforms, including those built on distributed ledger technology and blockchain technology, and new forms of digital assets, such as cryptocurrencies, stablecoins, and central bank digital currencies, or CBDCs. Given the new capabilities they could enable, we are seeing increased interest in and experimentation with these innovative technologies. This experimentation is happening in the private and public sectors, both domestically and internationally. In my view, as both the issuer of U.S. currency and an operator in the payment system, the Federal Reserve must understand these developments and the trade-offs they introduce. Our engagement with innovation is critical so that we can continue to support a safe and efficient payment system into the future. We continue to speak to a broad range of stakeholders and conduct basic research in emerging technologies that might support a CBDC payments backbone or for other purposes in the existing payments structure. For example, the Fed CBDC research program is currently focused on system architecture, notably how ledgers that record ownership of and transactions in digital assets are maintained, secured, and verified, as well as tokenization models, that is, the design of the digital analog to the paper banknote that permits a transfer of funds between two parties without direct facilitation by the issuing central bank. Of course, investigation and research are very different from decision-making about next steps in terms of payment system development, and we are a long way from that. The Federal Reserve has made no decision on issuing a CBDC and would only proceed with the issuance of a CBDC with clear support from the executive branch and authorizing legislation from Congress. Given the importance of this infrastructure, investigating the potential opportunities, risks, and trade-offs for payments innovation is one way the Fed fulfills its role in supporting the responsible innovation that enables a safe and efficient U.S. payment system. Now let me turn my attention to recent actions by the Federal Reserve that are aimed at promoting responsible innovation in financial services more broadly. Last month, the Federal Reserve announced that we had created a novel activity supervision program to focus on the supervision of risks posed by novel technology-driven activities at banks. At present, these activities include those involving crypto assets, distributed ledger technology, and complex technology-driven bank partnerships with non-bank fintechs. That said, this program will grow as new technologies emerge. By dedicating a team of supervisory experts to the oversight of novel technology-driven activities, our aim is to provide clarity as well as timely and relevant feedback to the institutions we supervise. We want them to continue to do the work to take advantage of innovations while also supporting their ongoing safety and soundness. One innovation that crosses both payments provision and bank safety and soundness is stablecoins, which can also be described as digital tokens that aim to maintain a stable value relative to a government-issued currency, such as the US dollar. When an asset is pegged to a government-issued currency, it is a form of private money. When that asset is also used as a means of payment and a store of value, it borrows the trust of the central bank. So the Federal Reserve has a strong interest in ensuring that any stablecoin offerings operate within an appropriate federal prudential oversight framework, so they do not threaten financial stability or payment system integrity. To provide clarity for banks interested in engaging with these assets, we recently issued guidance on the process by which a Fed-supervised bank can seek to obtain a supervisory non-objection before issuing, holding, or transacting in dollar tokens. As the Board of Governors announced in January, before those banks engage in these activities, they are advised to obtain a written supervisory non-objection from the Fed, verifying that they have appropriate risk management and systems in place to identify and control potential risks, such as those related to cybersecurity and compliance with anti-money laws. The guidance only covers the activities of the banks over which we have supervisory authority. But there are big risks when the Federal Reserve does not have direct supervisory and regulatory authority. I remain deeply concerned about stablecoin issuance without strong federal oversight. As I mentioned earlier, stablecoins are a form of money, and the ultimate source of credibility in money is the central bank. If non-federally regulated stablecoins were to become a widespread means of payment and store of value, they could pose significant risks to financial stability, monetary policy, and the U.S. payment system. It is important to get the legislative and regulatory framework right before significant risks emerge. We appreciate the work Congress has been doing on this important issue and look forward to further engagement to ensure that there is a robust federal framework for all stablecoins. As everyone in this room knows, innovation never stops. We are continuing to explore new technologies so we can continue to support a robust payment system that meets the needs of the public. We are committed to supporting responsible innovation, both through our provision of payments rails and through timely and relevant supervisory feedback to the institutions we supervise. Looking ahead, we will continue to engage in exploring new technologies, including those could be used to further advance our provision of payments rails. As I mentioned, this work involves continuing to study the next generation of ledger technology. In conclusion, I want to applaud the Federal Reserve Bank of Philadelphia for supporting the stakeholders coming together at these conferences, giving us opportunities to learn from each other as we engage in this important work. Thank you very much.
Thank you, Vice Chair Barr. It's cool to hear your perspectives on the imperative of innovation, and in particular your phrase that innovation never stops. And now not all being biased in liking that line as the Chief Innovation Officer.
Also, you are someone who never stops.
I don't, yes. You know, I wanted to start by double-clicking on some of your remarks where you illustrated the depth and breadth of innovation that's happening in the payments ecosystem in the private sector, but also you touched on the work that's happening within the Fed, through FedNow, through our CBDC research. And you mentioned a few imperatives as part of the core principles when we think about this innovation in payments, in particular financial inclusion. So I wonder if you could maybe expand on how innovators in the private sector, within the Fed, public sector, how we should be thinking about incorporating those use cases around financial inclusion as we interrogate innovation.
Thanks very much for that question. You know, I started to say in the remarks that the payment system is one of these aspects of finance that is so critical for people's everyday lives. Most of us can kind of take for granted that we can get paid, we can store our money, and we can pay bills in a pretty seamless way. If you're in the higher, let's call it higher socioeconomic classes of people who have access to these kinds of financial services. But if you're a low or moderate income person, payment services actually can be a real problem. It can be hard to receive your income. A lot of people still get paid by check and have to get that check cashed somewhere. A lot of low-income people, 5% of Americans are outside the banking system, don't have a bank account at all. 15% of Americans, according to the FDIC, are underbanked. That is, they have a bank account, but they still use expensive alternative financial services. A bank account, the structure of bank accounts can be expensive for people. And so all the effort that that low-income people put into payment system could be spent on other things like, paying for groceries or taking their kids to a soccer game. It should be as seamless and easy as low cost for a low-income person as for somebody with greater means. And low-income people need these financial services even more because they don't have any financial slack. And without financial slack, a small problem for a low-income person can turn into a big one. If you have to, if you end up with an overdraft on your bank account, that can be expensive. If you end up needing to wait for your paycheck and you have to go to a payday lender, that's a very expensive proposition. So low-income people have no slack, and that means that small problems can grow into big ones. And that's why it's, I think, so important that when we're talking about changes to the payment system, we have financial inclusion front and center. I listed a bunch of principles that are really important to me in the payment system. I started with financial inclusion, and I did that on purpose because we usually don't start with financial inclusion. And if we don't start with financial inclusion, we won't design products and services to meet the needs of low and moderate income people. We can't have innovation that works for everybody that tacks on financial inclusion at the end. It's got to be a core value from the beginning.
I think that's a helpful, heuristic, because oftentimes innovation can sometimes get a bad rap because it can be viewed as chasing shiny objects. So I think the core principles and really, kind of anchoring it around financial inclusion underscores that innovation should be rooted in, as you said, problem statements and thinking about personas and all personas. Speaking of solving problems, you touched on the announcement around the Novel Activities Program. So maybe talk a little bit more about, from your vantage point, what problem were we wanting to solve? And again, how you view that program perhaps being a tailwind from an innovation perspective.
Thanks. So we established the Novel Activities Program formally in July. It's something we've been working on over the course of the last year and have been piloting throughout the Federal Reserve System with a more informal mechanism this over the last few months. And the idea of it is to make sure that we can provide clarity to banks that we're working with and provide informed and timely feedback to supervised institutions. One of the things that we've been seeing in the banking system is there are lots of banks that would like to participate in this wave of innovation, and some of them are doing that in a way that is, already up to the right standard of safety and soundness and consumer protection and anti-money laundering protection and the like. And other institutions had some learning to do. And so what we want to do with this Novel Activities Program is make sure that the institutions we're supervising are doing that in a safe and sound way with appropriate consumer protection, with appropriate anti-money laundering and BSA and other compliance. And I think that this team of experts will work with local supervisors on the ground to make sure that our institutions have access to that expertise, access to that clarity, and that timely and expert judgment.
And I think the construction of the team is innovative in itself, kind of, partnering with them that it's examiners, but it's examiners who are working alongside data scientists and technologists. So I'm guessing that's a new framework for how we think about talent for examination, right?
Yeah, I think it's really important that we have interdisciplinary teams working on these sets of issues, because the problems that arise are not purely the province of economists or accountants or lawyers. They're also the province of engineers and data scientists. And, I would argue we probably need to do even more of that, bring more interdisciplinary expertise to bear, not just on novel programs, or our novel program, but more broadly at the Federal Reserve. I think we'd benefit from that interdisciplinary connection that can provide subject matter expertise, but also help the team avoid blind spots that can result in problems.
And I think maybe just to continue on that line around talent, you're 1 year into, I think, your time at the Fed. I have a little bit of tenure on you because I joined 6 months before you. That's the only most people I have no tenure on at the Fed. But I was watching one of those post-earnings calls interviews recently on one of the business channel, and the interviewer was talking to the CEO of one of the big donut coffee companies, and it was this cheeky meme where the CEO was like, well, let me say first, we are a technology company first, and then it's about the bagels and the donuts. I'm like, wait, what? As cheeky as it is, I think what it underscores is that every business, in essence, is a technology company, right?
I'm a technology company first and vice chair second.
There you go, right? Well, we'll be checking your code on GitHub soon. So the Fed in itself is going through its own journey around digital transformation, right? You use the example of the Novel Activities Program as an example where we are rethinking the type of talent we need, but maybe, we have innovators and builders in the room, folks from the private sector. How do you think about that larger talent question, right? Because we really can't enable real innovation or transformation without that substrate of the right talent and skills. So maybe talk about that more from a larger Fed perspective.
Well, I think that's a great point, and we do need expertise from all different kinds of sectors to come into the Federal Reserve and work with us. Sunayna has built an absolutely fantastic distributed team around the system that includes lots of people who have come in from technology, from data science, and from other fields. I recently, earlier this year, gave a talk to a group of students from historically black colleges and universities in Mississippi. And when I started talking to them about the technology opportunities at the Federal Reserve, I mentioned the word crypto, and their eyes, lit up. There you go. Their eyes lit up as being an interesting opportunity. So I do think we can attract people to come work in the Federal Reserve System, and do attract people to come into the Federal Reserve System who are interested in working on cutting-edge technology issues from the perspective of the mission we have to serve the public. It's a great honor and a privilege to be able to work at the Federal Reserve where our mission is serving the public. And to be able to combine that expertise with that mission, I think it's a great opportunity.
We like to think of it as Fed core, come serve, and give back to your country and do a couple of years at the Fed, bring your unique skill sets, but the learning curve can also be very steep in just a few years of exposure at the Fed.
So we've got AmeriCorps, we've got the Peace Corps, now we have the Fed Corps.
Watch out, here comes Fed Corps. So one of the prevailing themes of this conference has really been around this notion of responsible innovation, right? It is a given that the volume, the variety, the velocity of new technologies and trends coming our way will only accelerate. We also heard from many of our panelists yesterday, and you referenced it. The ultimate boss is the consumer, and consumer behaviors and expectations are evolving, and they're not going to regress. They're going to want the next best experience. We're seeing it play out right now with generative AI, which is obviously having its Cambrian moment. From your vantage point, talk to us about whether you're an innovator in the private sector or also the Fed's role in interrogating and applying these technologies. How do you strike that equilibrium of leaning in, trying new technologies, the application of these technologies, but doing it with that sense of responsibility?
Yeah, I think it's absolutely critical. I mean, I mentioned this briefly in my remarks, but for innovation to be successful, there need to be clear guardrails. We really need innovation. Innovation is absolutely essential for our economy more broadly. You know, innovation is the bedrock of growth and productivity, and that's true in the financial sector too. It needs to take place within guardrails so that we can, first of all, so there's a level playing field for competition. And secondly, so that we make sure that consumers are protected and that we don't pose risks to financial stability, we don't pose risks for illicit finance. And so that's what it's about. It's about, you know, getting that balance right. I will say, both as an academic and as a practitioner, that it's hard to get that balance right. It's not an easy line to do. And as I've mentioned in other contexts, you want to make sure that you have guardrails in place that protect consumers and financial stability and guard against illicit finance. You also want to make sure that your guardrails don't lock in old technology or lock in incumbents at the expense of innovation and entrepreneurship. And so that's a very difficult balance.
But a balance worth striking, right? Because the
balance we have to
technologies are
strike.
not going away.
Balance we have to strike.
I know we've come up to time, you know, when I was an innovator in the private sector and when I was first approached about Chief Innovation Officer at the Fed, I was like, wait, innovation, central banking is not like an oxymoron. But I'm happy to be proven wrong that it is not. And I think that's a large part due to leaders like you kind of championing innovation, both within the Fed, but also kind of leveling the playing field for innovators in the private sector to kind of bring their magic to the table. So I want to thank you for that. Thank you for your remarks and joining us at the Philly Fed conference.
It's my great pleasure.